You're at checkout, staring at four easy payments of $24.99, and you don't even hesitate. It doesn't feel like spending money. That's not an accident. There's a concept in behavioral economics called the pain of paying, first described by a researcher named Ofer Zellermeyer at Carnegie Mellon back in 1996. It's the emotional sting you feel when money leaves your hands. Cash hurts the most. Credit cards hurt less. But buy now, pay later was engineered to make that pain disappear entirely. And when spending stops feeling like spending, people spend more. Nearly 60% of Americans who use BNPL admit they're buying things they can't currently afford. But here's what caught my attention. The companies offering these loans, they're losing money on them. So, what exactly is going on here? To understand this, you need to see how the money actually moves behind that checkout button. When you split a $100 purchase into four payments on Klarna, Klarna doesn't reach into its own pocket to pay the merchant. In the United States, Klarna isn't even a bank. It partners with WebBank, a small industrial loan company based in Utah, to originate the loan. Affirm works the same way, relying on a handful of bank partners to create almost every loan on its platform. The capital behind these loans comes from institutional investors. Affirm alone has roughly $23 billion in funding capacity across asset-backed securities, warehouse facilities, and loan sale agreements. Sixth Street Partners committed $4 billion. Liberty Mutual put in $750 million. PGIM committed $500 million. Klarna sold $26 billion worth of its consumer loans to Nelnet, which is a student loan company. PayPal sold about $7 billion in pay-in-four loans to Blue Owl Capital. These BNPL loans get bundled together and sold as securities to pension funds, insurance companies, and credit funds. So when you split your sneaker purchase into four payments, your debt doesn't just sit with Klarna. It gets repackaged and ends up in someone's retirement portfolio. That's the financial machinery sitting behind a button that says, "Pay later." Now, someone has to pay for this whole operation, and it isn't you. It's the merchant. Standard credit card processing fees run about 2%. BNPL providers charge merchants anywhere from 3 to 8% per transaction, plus around 30 cents on top. Affirm charges roughly 6%. Klarna ranges from about 3.5% to 6%. Afterpay sits around 4 to 6%. Merchants accept these fees because BNPL increases their average order sizes by 20 to 40% and lifts conversion rates. But those costs don't just vanish. They get built into the price of every product on the shelf, which means even customers paying cash or using a regular debit card are subsidizing the buy now, pay later system, whether they use it or not. So here's the problem. The pay-in-four model, the thing BNPL companies became famous for, does not make money on its own. The merchant fees help, but they don't cover the cost of lending, servicing, fraud, and defaults. And that's why these companies are quietly becoming something else entirely. Klarna went public in September 2025 on the New York Stock Exchange at $40 a share, valued at about $15 billion. But in its IPO filings, Klarna didn't call itself a buy now, pay later company. It called itself a global digital bank, and its financial results explain why. By the end of 2025, Klarna had two types of customers. Regular users who just split payments at checkout generated about $30 in revenue each. But banking consumers, the ones using Klarna's interest-bearing installment plans, its credit card, or its savings accounts, generated $107 per user. That's 3.5 times more revenue. Klarna's interest-bearing installment product, called Fair Financing, saw its volume surge 165% year over year. Interest income grew from $174 million in one quarter to $269 million the next, and it now makes up nearly 30% of Klarna's total revenue. Sebastian Siemiatkowski, Klarna's CEO, said the strategy out loud in an earnings call. Acquire customers through seamless payments, then deepen those relationships into banking. The free pay-in-4 product was never the business. It was the door. The interest-bearing loans at rates up to 36.99% APR, those are the business. Affirm followed the same path. Its interest-bearing loans, ranging from 0 to 36% APR, remain its largest revenue source. By fiscal year 2025, Affirm finally turned a quarterly profit, but only because of the interest income from loans sitting on its balance sheet. These companies told consumers they were the antidote to predatory credit cards. Klarna's own CEO called credit cards high-interest, exploitative products, and said Klarna was building the transparent alternative. But the products driving their revenue now, installment loans at up to 37% interest funded by securitized consumer debt, look a lot like the thing they claimed to be replacing. And here's where it gets stranger. In May 2024, the Consumer Financial Protection Bureau issued a rule that would have classified BNPL accounts as credit cards under federal law. That would have given BNPL users the same protections credit card holders have had for decades, things like dispute resolution rights, refund protections, and standardized billing statements. For a brief moment, you actually had those protections. Then in early 2025, new leadership at the CFPB reversed course. By April, the rule was withdrawn entirely. The agency said it didn't believe BNPL lending was appropriate for credit card regulations. The rest of the world went the opposite direction. Australia implemented full BNPL regulation in June 2025, requiring providers to hold credit licenses, conduct affordability checks, and join a complaints authority. The UK's Financial Conduct Authority confirmed BNPL regulation starting July 2026. The European Union's Consumer Credit Directive brings BNPL under full consumer credit law across all member states in 2026. The United States is now the only major market moving toward less regulation of buy, now pay later, while every other developed economy tightens it. Meanwhile, the signs of strain are showing up in the data. 41% of BNPL users reported making a late payment in the past year, up from 34% previously. 60% have held multiple BNPL loans at the same time, and nearly a quarter have juggled 3 or more simultaneously. 1 in 4 Americans now uses BNPL to pay for groceries, up from 14% just a year earlier. Not electronics, not furniture, groceries, and 48% of all BNPL users say they've regretted a purchase they made using these services. Among Gen Z, that regret number climbs to 64%. None of this means buy now, pay later is inherently bad. If you pay on time and use it for planned purchases, the interest-free pay-in-4 model genuinely beats a 24% APR credit card. The argument isn't that BNPL is a scam. The argument is that BNPL companies cannot survive on the product they marketed as their mission. The product that actually pays the bills is interest-bearing lending, funded by institutional capital operating in the one major country that just pulled back the only federal attempt to regulate it. Next time you see that checkout button offering 4 easy payments, you'll know what's behind it. It's not a payment plan. It's the front door of a lending operation that's quietly becoming the thing it promised to replace. If this changed how you see that button, subscribe. I break down how money actually works on this channel.